Okay, so you want to own a Viking trading ship. You picture a broad wooden hull leaving a Norwegian fjord beneath a striped wool sail. The hold is packed with whetstones, soapstone vessels, furs, rope, and perhaps a few pieces of walrus ivory. 5 days later, you enter Hedeby with goods that farmers, smiths, and wealthy households cannot easily obtain locally. A merchant places silver on a balance. You sell the cargo, refill the hold with cloth, glass, salt, wine, and metal, then sail home richer. That is the dream, and it is not entirely wrong. Viking Age merchants connected trading towns from Koppang and Hedeby to Dublin, Birka, the Russian rivers, and markets far beyond Scandinavia. But one number changes the picture. Reconstructing the 90-square-meter wool sail for a Viking cargo ship required wool from roughly 200 sheep and about 7,850 hours of weaving. Before your ship carries one profitable object, years of skilled labor can already be hanging from the yard. And the sail is only one component. You still need the hull, mast, ropes, iron rivets, tar, steering gear, anchors, provisions, crew, cargo, market information, and enough silver to survive a failed sail. The ship is not a floating shop. It is a moving balance sheet exposed to weather, theft, delay, political power, and 2 different markets. So let us buy an ocean-going Viking trader around the year 1000. We will model a broad cargo vessel similar in purpose to the ships later represented by Skaldalef I and the Klastad wreck. By the end, we will load the hold, sail from Norway toward a major southern market, sell twice, and calculate what remains. Then we will cut the sale price. We will damage the rig. And we will see why a ship can return safely while the voyage still loses money. First, forget the dragon-headed longship. A warship is designed to move many armed men quickly and to operate under oars as well as sail. A trading ship gives up speed, rowing positions, and crew space to create a deeper, wider hold. The ocean-going type, commonly called a nar, has a fuller body, a small working crew, and most of its useful volume reserved for cargo. That difference changes the entire ledger. A longship earns through power, service, tribute, or violence. A merchant ship earns only when goods arrive where someone will pay more than the total cost of moving them. The hull does not create value by itself. It creates the possibility of changing the location of value. That possibility is expensive to purchase. Exact Viking Age ship prices rarely survive in a form that lets us build a universal purchase invoice. Experimental archaeology nevertheless shows the scale of the resources hidden inside one vessel. A smaller coastal trader reconstructed from Skaldalef III required about 20,000 working hours when built with period-style methods. Its sail and ropework alone accounted for roughly 5,000 of those hours. A larger ocean trader needs more timber, more rigging, more sailcloth, stronger gear, and a larger reserve for repairs. The hull begins with trees selected for specific shapes. Oak or pine must be felled, split, and hewn while the grain still follows the finished plank. Iron must be produced and forged into rivets and fittings. Wool or flax must be processed into sailcloth. Rope must be twisted from valuable fiber. Tar must seal and preserve the wood. Buying the ship means buying the organized labor of forests, farms, smithies, weaving rooms, rope makers, and boat builders. It may also mean sharing ownership. The Viking Ship Museum notes that a large trader such as Skaldalef may first have belonged to a chieftain or to a cooperative group of merchants. That structure makes sense. One household can provide cargo. Another can provide silver. Another can provide experienced sailors. A powerful patron can provide protection and access to markets. Shared ownership reduces the capital burden on one investor. It also divides the profit and creates arguments over cargo space, timing, risk, and who decides when the weather is acceptable. Now inspect the ship itself. Our model uses an ocean-going vessel with roughly 20 tons of maximum cargo capacity and a crew between 6 and 15. The real number aboard changes with voyage length, watch schedules, cargo, weather, and whether additional protection is needed. A small crew preserves cargo space. It also leaves fewer hands when the sail must be reefed, the ship bailed, the steering gear repaired, or the vessel pulled away from danger. The ship can be moved by a few oars in harbor or calm weather. It is not designed to row a fully loaded cargo across the North Sea. Without wind, your asset waits. With the wrong wind, it may move away from the market you plan to reach. The first hidden cost is therefore time. A farm can continue producing while the owner waits for a buyer. A ship consumes provisions while waiting for wind, harbor access, news, or protection. The crew still eats. The trading season becomes shorter. Perishable goods become less valuable. A missed market can turn a carefully selected cargo into storage aboard a wet wooden hull. The second hidden cost is cargo sacrifice to the voyage itself. Food, water, bedding, tools, spare timber, rope, sailcloth, anchors, weapons, and personal equipment all occupy useful capacity. 20 tons of maximum cargo does not mean 20 tons of saleable cargo on every departure. The farther you travel, the more of the ship must support the people and equipment that make the voyage possible. The third cost is maintenance. Clinker-built planks flex in heavy seas. Caulking can loosen. Rivets work. Rope wears. The sail stretches, tears, and absorbs weather. The steering oar and its strap can fail. A merchant who spends every piece of silver on cargo has created a profitable voyage that cannot survive its first serious repair. The fourth cost is protection. Trading towns needed merchants to feel safe, and kings or local magnates often guaranteed that safety. The same authority could demand duties, tolls, gifts, or fees. You are not entering an empty beach where price is decided only by two honest traders. You are entering someone else's protected market. The ruler controls peace, access, and sometimes the scales, coinage, and terms under which strangers may trade. The fifth cost is information. A cargo is valuable only if the destination wants it when you arrive. Norwegian soapstone vessels were heavy, everyday goods, often weighing 5 or 6 kilograms each. Whetstones were useful and widely exported. Furs and walrus ivory could carry high value in compact space. But a hold filled with yesterday's profitable product can arrive after local demand has already been satisfied. You need to know what is scarce, what has become common, which route is safe, and which market still has silver. That information can be worth more than another ton of cargo. Now choose a route. The late 9th century merchant Othere described a journey in which the passage from Koppang to Hedeby could take about 5 days. That does not mean every voyage took 5 days. Wind, route, stops, cargo, and season could change everything. But it gives us a useful commercial corridor. Koppang exported goods such as whetstones, soapstone vessels, skins, feathers, and walrus products. Hedeby connected Baltic and Scandinavian trade with Western European cloth, glass, ceramics, salt, wine, millstones, and metals. This is exactly what a merchant needs. Not simply a destination with buyers, but a destination containing cargo for the return leg. An empty ship coming home has completed only half a business. Now load the outward hold. The first revenue strategy is bulk regional cargo. Whetstones, soapstone vessels, timber products, rope, iron, or food can fill substantial capacity. Margins per unit may be modest. The advantage is repeatable demand. Smiths keep sharpening tools. Households keep breaking vessels. Towns keep consuming fuel, food, timber, and building material. A merchant can earn by moving ordinary goods more efficiently than they can move overland. The second strategy is compact, high-value cargo. Furs, ivory, amber, jewelry, fine textiles, and selected metalwork use little space relative to their possible value. These goods can create large gains from a small part of the hold. They also attract theft, political attention, and violent competition. High value per kilogram reduces transport pressure. It increases security pressure. The third strategy is freight for other owners. A merchant does not need to purchase every object aboard. Farmers, craftsmen, magnates, and other traders may pay for cargo space or offer the shipowner a share of the sale. This reduces the owner's inventory risk. It also means the vessel can be full while much of the cargo profit belongs to someone else. The fourth strategy is passenger and specialist transport. Messengers, craftsmen, envoys, settlers, and traders may need passage with their goods. They bring payment, connections, and sometimes protection. They also consume food, sleeping space, and cargo capacity. A valuable passenger can improve the route. Too many passengers turn a cargo ship into an expensive lodging platform. The fifth strategy is the return cargo. This is not a secondary detail. It is the difference between transportation and trade. Cloth, glass, wine, salt, ceramics, metal, and luxury goods can be purchased where they are more available and sold where they are scarce. The best voyage earns twice from the same hull. The weak voyage spends its profit carrying air home. Now consider how payment works. Silver became increasingly important in Viking Age trade, but it was often valued by weight rather than by a coin's face value. Coins, ingots, jewelry, and cut pieces could all enter the balance. The merchant needs scales, weights, and the ability to judge silver quality. That creates another business risk. A sale can look complete while the payment is underweight, debased, clipped beyond expectation, or difficult to use at the next market. Barter creates a similar problem. Receiving goods instead of silver means accepting a new inventory decision. You have not completed the trade. You have changed the shape of the risk. Now let us construct a voyage ledger. No complete Viking merchant account survives for our ship, route, and cargo. The following numbers are illustrative silver value units, not a claimed Viking industry average. Assume the owners commit 100 units of silver value to one round voyage. 52 units purchase the outward cargo. The hold combines heavy whetstones and soapstone goods with smaller quantities of furs, rope, and higher value material. 12 units support crew provisions, voyage shares, and household compensation for labor taken away from land. 8 units cover harbor duties, market fees, local gifts, guides, brokerage, and unavoidable friction at both ends. 8 units enter the maintenance reserve for tar, rope, sail repair, ironwork, steering gear, and emergency timber. 10 units remain untouched for delay, replacement cargo, medical needs, ransom, legal disputes, or a forced winter stay. The final 10 units represent the annual reserve for the hull, sail, and major equipment that eventually must be replaced. The ship leaves with 100 units committed. At Hedeby, the outward cargo sells for 82 units. The gross trading gain on those goods appears to be 30 units above their 52-unit purchase cost. But most of the voyage has not yet been paid for. The merchant reinvests 60 units in cloth, salt, glass, metal goods, and selected luxury items for the return market. 22 units remain as silver or easily carried value. Back in Norway, the return cargo sells for 88 units. Add that to the 22 units retained after the first sale. The voyage finishes with 110 units of value. The apparent profit is 10 units. The ship crossed open water twice. 2 cargoes were sold. The outward goods rose from 52 to 82. The return goods rose from 60 to 88. And the owners kept only 10% on the total capital committed. That is before assigning a full wage to an owner who personally sailed. It is before charging for land or farm work neglected during the voyage. It is before any argument among partners over whose cargo received the best space. This is the first financial trap. Large markups on selected goods do not mean a large return on the entire voyage. Cargo profit must carry the ship, crew, reserve, delay, and return journey. The second trap is the empty leg problem. If the outward cargo sells, but no suitable return goods can be purchased, the ship may come home with silver and unused capacity. The owners avoid inventory risk. They also lose the second margin that justified moving the hull twice. The third trap is concentration. A hold filled with one commodity is efficient to load and easy to sell if demand exists. One price collapse can damage the entire voyage. A mixed cargo reduces that risk. It also requires more buyers, more negotiation, and more knowledge. The fourth trap is liquidity. Silver in the chest is flexible. Furs, stone, cloth, wine, and iron are not. A ship can carry substantial wealth while lacking the exact payment needed for a toll, repair, or urgent purchase. Now change one variable. The return market is weaker than expected. Instead of selling the return cargo for 88 units, you receive 15% less. The sale produces about 75 units. Add the 22 units already retained. The voyage ends with roughly 97 units. Nothing sank. Nobody stole the cargo. The ship returned. The owners still lost about 3% of the capital committed. Failure looks like a safe vessel tied at the quay while merchants argue beside a full account chest. Now change a second variable. A storm damages the sail and steering gear before the outward market is reached. Repairs and delay consume 12 units beyond the planned reserve. Water damages cargo worth another 5 units. The merchant arrives late, accepts a weaker price, and misses the best return purchase. The hull survives. The crew survives. The voyage can still lose more than the value of several successful cargo transactions. This is why the sail is not simply propulsion. It is a capital asset that determines whether every object beneath it can reach a buyer. The real archaeological failure is the Klastad ship. Built around the end of the 10th century, it was a Viking-age merchant vessel about 21 meters long with roughly 13 tons of cargo capacity. When it was wrecked around the year 1000, sharpening stones from Eidsborg remained aboard. The exact cause of the wreck is uncertain. The financial result is not. The stones had been quarried, shaped, transported to the coast, loaded and carried into a voyage. Then the conversion stopped. Cargo that should have become silver remained at the bottom of a failed journey. The loss was larger than the ship. It included the labor inside every whetstone, the capital of whoever owned them, and the future return cargo that was never purchased. A shipwreck is not merely damaged transport. It is an interrupted chain of transactions. That is what maritime failure looks like physically. The hold is still full. The revenue is gone. Now compare it with a stronger operating model. A strong trader uses a seaworthy cargo ship like the type represented by Skaldalef 1. The hull is broad enough to carry volume, shallow enough to enter useful waters, and operated by a crew small enough to preserve capacity. The ship is maintained before failure. Skaldalef 1 itself shows repeated repairs using wood associated with different Scandinavian regions. That suggests a working vessel kept valuable through continued maintenance rather than discarded after its first hard service. The strong merchant also knows both ends of the route. Buyers are identified before departure. Return goods are planned before the outward cargo is sold. Cargo is divided between dependable bulk demand and smaller high-value opportunities. Silver reserves remain available. No single passenger, partner, or commodity controls the whole voyage. The weak operator buys whatever was profitable last year. The strong operator buys what is scarce at the destination now. The weak operator fills the ship before asking what should come home. The strong operator treats return cargo as part of the original plan. The weak operator spends every unit on goods. The strong operator keeps enough silver to repair the ship, wait for weather, and refuse a desperate sale. The weak operator sees maximum cargo capacity. The strong operator sees usable capacity after provisions, equipment, people, and safety margins. A mature buyer therefore inspects much more than planks and sail. How much cargo can the ship carry in the water it actually uses? How many crew members are required for a multi-day passage? How old are the sail, ropes, caulking, steering gear, and iron fittings? Which harbor authorities can stop or tax the voyage? Who owns the cargo? Who bears the loss if goods are wet, stolen, or sold badly? Which buyers are waiting? What will fill the return hold? How much silver remains after departure? How many voyages can the hull complete before the next major rebuild? Those questions reveal the actual asset. Future change can strengthen or destroy it. A new protected trading town can create buyers, safety, and regular routes. A ruler can increase tolls or redirect trade toward another harbor. A new source of silver can make distant commerce more attractive. When that silver flow weakens, an established eastern route can lose part of its purpose. Competition from another port can move Norwegian merchants toward Dublin instead of Koppang. Larger ships can reduce transport cost per unit while making each voyage more dependent on filling the hold. So can owning a Viking trading ship make you wealthy? Yes. The ship can move ordinary goods farther and more cheaply than land transport. It can connect producers with buyers who value the same object differently. It can earn on outward cargo, return cargo, freight, passengers, and access to distant markets. But the vessel does not manufacture profit. It concentrates risk. Every voyage places the hull, cargo, crew, season, market, and political permission inside one moving investment. The ship is not the business. Knowing what to carry, where to sell it, and what must fill the hold on the way home is.